Welcome back again. This is City, your Canadian accountant. As I previously promised, I am back with a special bonus episode.
And this is ICE. We're interrupting our regular OVBA series because on last week, November 4th, 2025, Canada's finance minister showing us the 2025 federal budget. And spoiler alert, it's strong instead of big and beautiful.
This 2025 budget is called Building Canada Strong. It is still pending on approval from the Parliament, but to be strong, there's going to be some pain. This is like you went to the gym and you need to spend on the gym membership and some protein shake. The strong budget is giving out a deficit of $78 billion.
So, are we broke?
Not broke, just heavily invested in optimism. Think about it, our neighbor down there is having a deficit of around $1.8 trillion.
And that is in the USD, just like our salaries would be the same amount in both Canada and the US, just that the currency would be different. But what do you mean, invested in optimism?
The government is betting that if they spend big on infrastructure, manufacturing, and clean energy, the economy will grow faster than the debt. They're expecting by 2028, the operating deficit will be offset with the profit from the investment today. It works like if I buy a house with mortgage and hope that the rental income would help me to offset everything, so the tenants help me to buy my house.
That would probably work in Toronto. Consider the rent are so high, but definitely not when the interest rate was 6%.
Welcome to fiscal policy. Talk about the interest rate. The Bank of Canada recently cut the rate again. On the same day, the Fed in the U.S. announced the rate cut in the U.S. as well. However, Mr. Powell indicated that they might not cut the rate again in December. In Canada, the core CPI seems to continue increasing, so I hope Bank of Canada can keep the interest rate just to see if the inflation on groceries can be controlled. But there are rumors that the rate will be cut again so the government's debt would not be as hurt as the mortgages that are issued in the last 2 years. Then
What do you mean by control the inflation on groceries? Is that why my grocery cost is getting almost doubled after COVID?
it is just based on the theory of a perfect world. The higher the interest rate, you would keep your money for saving, earn more back, and not heading to borrowing since it costs more. You buy less, the demand of the market is lower, there are surpluses in the market causing your vendors need to reduce their price. But looking at the Canadian public grocery stores' financial statements, they are rich, and I guess they don't control the price of groceries.
I see. No wonder there was a high interest rate that prompted me to open some saving account during the COVID time. It was a measure to help the high inflation environment as a lot of things are considered higher demand than supply.
City, let's get back to this year's budget before revision from the Conservatives or NDP. It seems like this budget is having some hard time to be approved in the Parliament just yet, but hope it is not as bad as the US that causing the government shutdown then.
While we haven't released the third episode of OBBA related to the corporation, but in short, the U.S. allows the qualified properties and qualified production properties to be expensed immediately without waiting for decades. They also allow the immediate expensing of the research and experimental expenditures. This is making the life of the accountants doing the tax easier as well. Well, Canada just said, hold my Tim Hortons.
Wait, that sounds familiar.
That is not wrong. During Justin, the corporation can start to immediate expense certain capital assets. This program ran between 2021 to 2023, which ended basically last year. It was the measure for the small business to invest into capital to reboot the economy after COVID. Under this budget, we are expecting the same treatment once again. However, this time, it is limited to the eligible manufacturing or processing building only. That means if you build a factory in Canada between November 4, 2025 and 2030, you can write off 100% of the cost immediately in the first year you use it for manufacturing.
So if I build a $10 million factory, I get a $10 million tax deduction in year one?
Exactly. At a 15% federal corporate tax rate, that's $1.5 million in federal tax savings. Think about it. If you had a manufacturing building before that, it would be a declining 4% each year. So you expensing almost like 25 years of expenses in a single year. But here's the catch. The building must be used 90% or more for manufacturing or processing. If you want to have a big office area that are using more than 10% of the building, you don't qualify. Make room for your colleague white collars.
Does this apply to existing buildings?
Nope. Only new buildings or major additions/alterations acquired on or after November 4, 2025. And the deduction phases down after 2030, disappearing completely by 2033. Stellantis, make sure your factory in B-Town is up and running soon to claim this deduction. But I guess with what you did, Canadians probably not going to buy that. You can just carry your loss for 20 years then.
Are you trying to talk about cars in the future, so you bring this up?
Maybe. I am not too sure whether this is Canada's direct hit back to OBBA, or just to extend what Justin did. Donald lets you write off factories, and Mark does it too, but it was Justin letting everyone just expense all capital assets. But I guess it is the way to enhance or keep the manufacturing in Canada. Think about it, the federal corporate tax in Canada is lower than the US when criteria are met. But the next one would sound more like another direct hitting back.
Are you going to talk about SRED incentives? Right. What's SRED again?
Scientific Research and Experimental Development. On the corporate tax, it basically known as Stop, Reach Out to Your Expert and Dependable Accountant. It's Canada's R&D tax credit program. If you're a company doing research, biotech, software, clean tech, you can get tax credits to offset your costs. The budget just increased the expenditure limit from $3 million to $6 million. That means small businesses can now claim the enhanced 35% refundable tax credit on up to $6 million in R&D spending.
So a company spending $6 million on R&D gets what?
If you are eligible for the 35%, then they get $2.1 million back in cash. It's refundable, meaning even if you have no taxes owing, the government cuts you a check. You don't need to use that in the next 20 years when you have income. It's like a research grant, except you're writing a 9-page-long tax form in your annual corporate tax return instead of a 50-page application.
That's actually amazing.
It gets better. The CRA is rolling out an AI-powered fast-track approval for low-risk claims starting April 1st, 2026, plus an elective pre-approval process so you can get technical approval before you spend the money. Processing time cut from 180 days to 90 days.
Wait, the CRA is using AI? Are they going to audit me via ChatGPT?
Not yet, but they're using AI to identify which claims are low risk so they can approve them faster and focus audits on the sketchy ones. Honestly, it's the smartest thing the CRA has done in years.
Hope they don't just give out grant randomly and demand a payback in interest like the last time with the COVID grant. I am in doubt if they can pull that and hope that the person approving the fund are not the same as the ones answered the phone. Based on the report from the Auditor General of Canada, the accuracy rate for personal tax is only 17%, and the benefit and business tax is about 55%. Basically, they can't even get the things right after you wait for 2 hours and talk to them on the phone.
I think the budget is going to right-size the public service. Not sure if this including any unqualified one in CRA.
Don't make your life more difficult with CRA. Make sure they don't know about your e-file number and rep ID.
Without further ado, City, can you just spice up today's episode of what we expect as a regular Canadian? Did we get anything?
Not much, but here's what changed. First, it is a weird but interesting one. Remember we talked about the personal tax credit rate in Canada at 15%? Before this budget, the tax credit was cut along with the personal tax rate to 14.5% for 2025 and then 14% in 2026. In this case, if your income is not at the first bracket, you are going to pay more tax even you are earning the same as last year.
That's evil.
Guess what? They introduce a top-up tax credit to fix it. It maintains the 15% rate for credits claimed on amounts above the first tax bracket. They probably ran some tax calculation on their salaries, so quickly put the Band-Aid on that self-inflicted wound.
Sounds more like an actual tax cut to me.
Another good news on the tax saving is the capital gain tax. Recall when Katy Perry's new boyfriend announced to include 2/3 of capital gain to income instead of half back in 2024? That thing is canceled, so the 50% stay.
So the government listened.
I am not too sure whether they listened or they just ran their personal tax calculation and noted that they are going to pay more tax. When I take a look at the budget, some of the measures seems good only for rich people.
What do you mean by that?
If you think of this, the capital gain inclusion rate was planned to raise for amount over $250,000. A normal individual that is trading stock or selling the house they live in would definitely not having this much of income out there. I trust there are people that are trade genius, but remember, those would be treated by CRA as business income instead of capital gain. And if you are selling the house you live, it is basically tax-free if you have the principal residence exemption.
So if you were going to have $250K from the capital gain, it would sound like someone selling their second or third houses, or when big companies selling their building. But that might just be the measure to make it easier since they just cannot figure out the detail on how to implement. What else you got there?
I believe another measure there to make it easier is to remove the underused housing tax. While it was still there for 2022 to 2024 and causing a lot of confusion on whether or not you should file. While it removes the federal UHT, the municipal one is still there. Don't forget to return your filing sheet for City of Toronto unless Olivia wants that gone too.
It is still some convenient measure. I think Justin was in a rush to add additional revenue for Canada, so the details were not drafted clear enough.
The next one is the luxury tax. This budget removes the luxury tax off the aircraft and vessels, but not the luxury tax on vehicle. So Mark can pay less on his yacht and charter plane, while some construction companies still need to pay extra on their light-duty pickup or van.
This is an interesting one, but we can also think these are the essential vehicles for the people that are living in the rural areas, say Churchill, Manitoba.
I hope that benefits Churchill by a lot, since we are expecting to lose $135 million in the next 5 years by removing that. And the most interesting one here is cancellation of the Canadian Entrepreneurs Incentive. It reduces the capital gain inclusion rate to 1/3 when entrepreneurs are selling their small business sales.
Seems like they don't want those entrepreneurs to sell and retire yet. The government just need them to continue to work hard to get more businesses outside of the US.
With a bit of tax planning to do, asset freeze, personal lifetime capital gain exemption, and some trust, this promotion that is gone from your boss might still be able to be made up.
Which I believe you are going to say these inheritance and tax saving tip are going to be your future topic.
That is correct. Well, the next one might be relevant to you. It is the Personal Support Workers Tax Credit. If you work as a personal support worker, or PSW, in a healthcare facility, from 2026 to 2030, you are qualified for a refundable 5% tax credit on eligible earnings up to $1,100 per year.
But it's for PSW, not for a nurse. I guess we will see all nurses in the hospital and long-term care having a job title of PSW. I somehow feel discriminated as nurses are still underpaid and overworked in Ontario. Yet we cannot go on strike like Canada Post. Just give me my $1,100 extra after tax pay for next year.
Heading back to other interesting things that we have in this budget.
Interesting things. After hearing that I cannot get that $1,100, nothing brings my attention anymore.
Or maybe we should just quickly review everything to see if anything is interesting. Theoretically, these are all for a bigger picture, but might be good if you are investing in the stock market.
Is this like in Brookfield we trust? Sorry, I meant in Mark we trust?
I think it depends. Maybe I should follow Donald on Truth Social and see how much I can make. Look at him introduce his friends that earned big bucks in the Oval Office. Compare with OBBA that abandoning the clean energy credits, Canada just went the opposite direction, classic liberal. In this case, we got Clean Electricity Investment Tax Credit, short as CEITC.
What can a company get out from there?
This credit applies to renewable electricity generation, wind, solar, hydro, nuclear. If you're building a $100 million solar farm, you get $15 million back. Something even better is Canada Growth Fund would not reduce your project cost on applying for this credit.
Are you saying that when Canada Growth Fund financed that $100 million project with $10 million, your project cost for CEITC is not going to reduce by 15% of the $10 million?
Yes, so instead of getting $13.5 million back, you're getting the full $15 million.
So Canada is literally making it easier to finance clean energy?
Correct. In this case, the infrastructure cost for the clean energy is likely to reduce. So think about the stock market.
I can definitely think of BEP.UN, AQN, CPX. Yes, Brookfield strong.
Above tickers are her thought about general information purposes only and not a personalized advice, nor we received any money to promote the shares. Please don't gamble in the stock market. To make it cleaner, the budget also introduced the expansion of the 30% Clean Technology Manufacturing Investment Tax Credit, short as CTMITC. The budget expands the list for antimony, indium, gallium, germanium, and scandium.
I have no idea what those are.
Neither do most people. Based on my quick research, they're used in semiconductors, batteries, and solar panels. Scientists, please correct me if I am too wrong on this.
I understand Canada is a country with a lot of natural resources, gold, copper, and now even the critical minerals. Interesting, is that why someone was trying to make us the 51st state?
They should just go back and help Puerto Rico first. Coming back to the CTMITC, the 30% credit means if you build a processing plant that supports low or zero emission for these minerals, you get nearly a third of your capital costs back.
I kept seeing some advertisement related to Ring of Fire in Ontario and saying about some critical minerals used for healthcare. Does that align with this budget policy?
Based on the same search I did, it says the critical minerals from Ring of Fire are different than those added to the list. But since these are both different measures that are trying to boost Canada's importance for the critical minerals, I will give them a pass score.
Let me guess, the next one is going to be another climate change prevention incentive.
And you are right. It is the Carbon Capture, Utilization, and Storage Investment Tax Credit Extension. The budget extends the full CCUS tax credit rates by 5 years, now available until 2035 instead of 2030. The rate range was set to decline a range of 37.5% to 60% to the range of 18.75% to 30% after the end of 2030, and now it becomes 2035. That broad range depending on how you use the captured carbon.
Wait, 60%? That's insane. I'm just curious whether they're using the carbon tax that they got from High Emission Corporation to subsidize the companies that investing in carbon capture.
Those carbon taxes that increased our gas price does not seem to directly pull to this tax credit. The tax credit is for direct air capture, literally sucking CO2 out of the air. If you build a plant that does that, Canada will cover 60% of your costs. It's expensive tech, but if it works, it's a game changer.
Reduce the carbon dioxide in the air and adding some hydrogen to make it sugar could be a sweet way to cool down the climate change.
Well, there are more benefits to the corporation that are going to innovations. The budget gets technical. The government is cracking down on tax avoidance schemes. The first one is a group of companies that were deferring taxes by creating chains of corporations with mismatched year ends.
Basically, Corporation A pays a dividend to Corporation B, but Corporation B's tax year ends after A's, so the tax gets delayed.
The budget shuts this down. If you pay a dividend to an affiliated corporation with a later year end, you don't get the dividend refund until that corporation pays it out to a real person.
That sounds complicated.
It would apply to the group that are having refundable dividend tax on hand, which coming from the investment income. So the small company probably not need to worry about it. This new measure stops companies from playing year-end games to get the dividend refund while the tax not need to be paid just yet for the recipient corporations. Think of it as the government saying, nice try, but we're not stupid.
What is another thing we got there to avoid the avoidance from the corporations?
Canada's transfer pricing rules, which govern how multinational companies price transactions between their subsidiaries, are getting a major overhaul. Remember the good old day when the profits were moving toward tax haven, they earned good money and not paying tax to where they earned them. The rules now align with OECD guidelines, meaning Canada is joining the global standard for transfer pricing. The penalty threshold increases from $5 million to $10 million, and documentation requirements are simplified. And I am not going into details since it would become another 2 episodes or more just to talk about transfer pricing.
Hope these would continue to prevent multinational companies shifting profits to low-tax countries by manipulating prices between subsidiaries. Canada could keep profits and taxes in Canada. After all, it is a $78 billion deficit. Should I be worried?
Yes and no. Yes, because that's a lot of debt. The budget projects deficits for the next 5 years, gradually declining to $57 billion by 2029-2030. The debt to GDP ratio will decline, but we're still adding debt. And no, because Canada is investing in infrastructure, housing, and manufacturing. If those investments generate economic growth, the debt becomes manageable. It's like taking out a mortgage. Scary at first, but if your house appreciates, it's worth it.
And if the economy doesn't grow?
Then we might become pigs.
You mean like the parents in the movie Spirited Away?
Kind of, but we are not dying because of the greed, just from overspending but not getting the return back. Just like you put your money to the stock market and accidentally picked a bad stock. Now it becomes part of your wallpaper along with your diploma and awards.
So, before we return to our original programming, what do you think if this budget is strong enough and against the big and beautiful?
Let's check the different criteria. Reduce of personal tax rate?
At least in the first bracket. We also reduced luxury tax and scrapped the proposed higher inclusion rate for capital gain. This is the part Canada tries to keep the talent.
Immediate expensing for manufacturing building.
Check.
R&D credit.
Check. I think we probably got the counterpunch of what the US got.
And since Canada trusts global warming where Donald does not, we expanded the clean energy, clean technology to process critical minerals. These incentives are there to encourage spending to bring up the economy.
As you say, Canada is trying to compete with the US on investment incentives while staying true to its climate goals. It's ambitious. It's expensive. We might go bankrupt. But let's hope for the best and see if there are going to be any changes from Conservative and NDP before the budget is approved.
That's the Christmas spirit. Hope for the best and send out the incentives as the gift. Welcome to Fiscal Policy.
Just to help you to do the wrap-up. 2025 federal budget result in $78.3 billion in deficit and expect to continue for the next 5 years. This year, we're working on massive investments in manufacturing and clean energy, enhanced R&D credits, and a few eliminated taxes that helps rich people.
Next week, we're back to our regular OBBA programming, Episode 3 for corporation taxes, incentives, and potential some benefits before I forgot.
And if you have questions about the budget and how it could impact your business or your property, hit us up. We'll do our best to translate government speak into actual English.
And remember, if you're confused and have doubt from the answer provided by CRA, maybe it is wrong considering their accuracy rate.
Stop hitting yourself in trouble. At least the government will offer free tax filing. They are good as long as they are accurate. All right, then. See you all next week.